Well, look what the Federal Reserve is taking into account, whether there is trade uncertainty, whether there are trade deals. If you pull away from those things, the outlook for how the Federal Reserve handles this changes. The whole interest rate complex would move on all of this. We would see rates back up. Now, the Federal Reserve does not want to inadvertently tighten monetary policy by forcing up interest rates, but it says it again that it's going to be lagging and it's going to be responding to trade developments. So that's why this whole market situation has become less predictable across asset classes.
Well, there's also this confusing question about whether the market even wants a rate cut. I mean, is that a good thing? It was good a few years ago, but at this point in the cycle, do you think it'll really carry the same kind of juice in the markets and the economy?
Look at, all else constant, the things that drive the Fed to ease monetary policy tend to be things that are negative for the outlook for profits, for the economy. So particularly in the last couple cycles, think about all the easing the Federal Reserve did in 2007, in the early part of 2008. Now, again, that can get very, very scary. It really depends on the Fed's reaction function. If the Federal Reserve simply wants to avoid inadvertent tightening, wants to take out insurance monetary policy easing steps at a time when the economy remains strong, I don't think that that's going to instantly cause some kind of trouble. But the bottom line is late cycle tightening and early cycle easing steps, are not the good news. Where the economy ends up heading after the Fed eases tends to be where you're really going to get returns.
Stephanie, do you think it does really help the economy if we do get a rate cut?
Not necessarily. I mean, I think that trade and tariffs are far more important. Obviously, you don't want a tight Fed, and you want them to be as accommodative as possible. And we know that they're trying to get there. But I think if they have to ease 3 times, guys, this economy is far, far slower and far softer than we all believe it to be, or that I believe it to be. So I'm kind of hoping they don't have to do it. Maybe once, but I don't think 3 times.
I mean, 3 times with an unemployment rate under 4% makes you also wonder whether they're going to have policy ammunition when we actually do get a recession or some sort of steeper downturn.
And so here's the problem. Manufacturing is definitely slowing. We see it in all of the PMIs, ISMs, factory orders, etc. But the consumer is still pretty good, pretty healthy. And by the way, guys, that's why tomorrow's job number is really, really important, because not only was ADP disappointing, but Challenger Gray was also disappointing today. So we need a good number. We need jobs, we need wages to help offset the slowdown in manufacturing. We don't get that, then that's when you're talking about maybe more easing than just one or twice.
Stephen, where do you stand on financials in this environment? Economy could pick up, but rates could be lower.
This move down, this flattening of the yield curve is negative for trading financials. Now, again, the whole source of this, how easily this could change, might change that whole picture if the economy is not at a peak. But again, when you think about what is going to happen with Fed easing and what is priced into markets, we are either going to have a little Fed easing, we're going to have a lot of Fed easing, or we're going to have none. And that's going to end up being the outcome of trade policy. And then when you think about how the Fed could fix things in the fourth quarter, they were the source of the problem, running tremendous monetary policy uncertainty, knocking markets down. They are not the source of this uncertainty this time around.
Stephanie, have you added to any of your bank holdings that we talked about before?
I added to Citi. I trimmed a little bit of BAC because of the yield curve and the implications. I don't think numbers have come down enough for some of the regional, super regionals, and also the names like Bank of America. I think they've come down for capital markets weakness, but not for the yield curve. And so I think numbers are at risk. On the offset of that, and the reason I added to Citi is actually because they're less impacted, but also in general, the CCAR numbers should be more favorable for Citi than anybody else.
Final word, Stephen, you're adding to defensive exposure?
So, look, I think in a news-driven environment, hedging is ideal. Just let's remember back, October of 2008, we had an 11.5% one-day rally in markets. The market didn't bottom until 6 months later. But as we saw this week, when there's apprehension, you can have a terrible impact if you're not invested. That's the ideal situation. Away from that, for those who can't, we're going to just take somewhat less risk in portfolios, try to get more safe yield in portfolios.